Welcome to Quickshots.
Welcome to Quickshots. James Fitzgerald here, and I'm joined by producer Nick Stevens. Welcome to debut on Quickshots.
Good to be here.
Good to be here, he says. Very good. I'll give you the honours. I'll let you serve first.
All right, we've got one from Chris. Which capital city or states are at the bottom of the property clock at the moment? Where do you suggest to keep an eye on, and basically where should I invest?
Yes, okay. There's a bit in that question, isn't there? Look, I mean, I'm not a prescriber to the property clock per se, but what I do think is, that there's good times to get into certain capital cities, and really everything follows Sydney. So, Sydney typically, for example, if I look at Melbourne, Melbourne's median house price as a percentage of Sydney will sit somewhere between 60 and up to 90%, and it's sitting at about 75%. So it's about halfway now, and that makes sense because people look at Melbourne and say, well, if it's 3/4 of the cost of Sydney for the same type of house, I'm not going to get paid 3/4 the amount. So I see Melbourne as being attractive. That's an example. So, that to me would suggest that there's still a little bit in Melbourne. Brisbane's at 65% today of the Sydney median house price. It gets as high as about 78 to 80%. So that suggests that one probably has even just a little bit more in it than Melbourne today. And then Adelaide sitting at about 55% of the Sydney median house price. That has gotten as high as sort of 70%. So similar to Brisbane in terms of, Brisbane and Adelaide still having a little bit to go to catch up to Sydney before people would start to sort of prefer to stay in Sydney as an example. And then Perth is less than 50% of the Sydney median house price. So those markets, I think, offer, say, a little bit more value today. And then within those markets, there's value. We talked about in the main podcast this week that the high end of the market has had a massive run, 50-60% growth over the past 12, 18 months, and that's coming off a little bit now. But the more affordable end of the market has sort of not had as big a increase in value, maybe 30-40% in some areas, maybe even some areas only 20%. So they're starting to still kick along at more than 10% per annum. So that to me is sort of my perspective. It will come down to your circumstances, of course, but I say to anyone, make sure you chat to someone who's got a bit of experience, whether it's a family member, a friend, or an expert if you don't have those, because they're going to be able to guide you with a bit more of a precise answer there, Chris. Nico, here you go. It comes from Divya, and it's a good one, and I'm interested to get your perspective on this. And the question is, what if I get into the market? So she's looking to buy at the moment. What if I get into the market at the at the wrong time? What can she do?
Yeah, I suppose the interesting one, and maybe sort of depends on, I guess, what you mean by the wrong time. Whether that's, you initially think you're buying at the peak and, what if I buy and it sort of goes down in the short term, or, wrong time, maybe personally I bought something and then, my personal circumstances have changed. So it's probably, two slightly different courses. I mean, we always say, you should only really be buying with a long-term view. So, if you are to buy and it's to decline in value within the first couple of years, well, you shouldn't even be thinking about selling. So really, it shouldn't matter. There might be other implications in terms of, I don't have the equity to be able to duplicate and expand or anything like that. But really, it shouldn't be adding any, financial hardship or stress to your day-to-day circumstance. The scenario of, I've bought and then, personally something's come up and for that reason I need to sell, I'd probably say look at all your options before you do. Whether that's, even when you're buying, making sure you've got enough sort of buffer up your sleeve, you've got that bit of emergency fund of sort of 3-6 months expenses sitting there because, life can happen at any time. And really, if you can avoid selling, particularly if it's a temporary issue, you know what I mean? If it's a temporary illness or loss of job or something like that. I think there'd be a lot of people who, especially in the last few years, that might have sold for those sort of reasons. And, hey, if I had borrowed 10 grand from family or something that avoided us having to sell, it probably would have, cost a lot more in terms of the sale cost and then the market moving and everything like that than even, a bit of interest or dirty debt to sort of get you through. So I'd say, if it's your personal circumstance, try and do everything you can to, avoid selling if at all possible. And if it's, the external market changes, then, you should be going into it with the long-term view.
Very good. I think the long-term views, that's the nail on the head right there. And I don't think that's just specific to property either. I think any investment.
Yeah. And cash flow. I suppose that's a big one too. If you're not set up correctly to start with, if you're not using things like your tax variation, if you're not getting your rates checked, if you're not pushing your rents, and it's having a material impact on your cash flow each week, well, then that's when you might end up forced into a scenario where you have to sell because it's causing too big of an impact. But if you can manage that correctly, then short-term value changes shouldn't be that relevant for you.
I agree. All right, you want to give me the last one?
All right, one from James. It's a sneaky self-submission by the look of it.
I don't think so.
Is there an ideal LVR or debt-to-income ratio?
So LVR, for those unfamiliar, is the loan-to-value ratio, and the debt-to-income ratio is the amount of debt that you've got as a multiple of your income. In terms of the loan-value ratio, I don't think there's an ideal loan-value ratio. If you can only put in a 10% deposit, then you're going to have to get a 90% loan-to-value ratio. So you just got to do the best that you can. What I do find is that if you're a high-income earner, there's generally more benefits and upside to borrowing 90% because you are in that really high tax bracket, so the mortgage insurance is tax deductible when it comes to your investment properties. But no, I don't think there is an ideal LVR per se. Debt-to-income ratio, likewise, the banks won't let you go above 8. What I think is a little bit more important than the debt-to-income ratio is what percentage of your after-tax pay are you putting towards your investments. I don't think that number should exceed 10%. So that's my general rule of thumb is work out the numbers based on, the interest rates, the likely rent, all the costs associated with that property, whether you're going to get some tax benefits, and make sure that whatever the cost is to hold that property does not exceed 10% of your after-tax pay. I don't think you can go wrong if you're doing that. It's, investing 10% of your after-tax pay into building your wealth. That to me is the rule of thumb that makes sense. So more so than, say, worrying about the LVR or debt-to-income ratio per se. James?
Maybe a bit more if, your age and you're at the start of the sort of accumulation phase, but I see what you think of this. I reckon your ideal LVR is 80%. So if it's under that, you've got a lazy equity sitting there and you're not utilising it.
Yeah, for investments, I agree. And then for your own home, you want it obviously, hopefully getting as close to zero. But 80%, that comes down to your risk appetite as well. But you can tell which end I'm at, can't you? Yeah, we can tell. Nick Cash-Stevens. But no, you're right. 80% is maximising your opportunities, absolutely. And it's what the banks will allow you to comfortably do, as many times as you want. So there you go. James, little hack again from producer Nick. Really delivered this week, Nico.
Mate, so I've had, 2 years of waiting on the sidelines, packing all this good information together.
I was wondering what that 17 pages of notes was that you brought in.
Yeah, so listeners, I'll see you in 2024 with some more great hack facts.
Thanks again, Nico. As always, pleasure to be in your company. What a treat for our listeners. First time debut, and it was an absolute ripper.
Thanks for having me on. Cheers, guys.
Thanks for listening to another episode of The Double Shot with your favourite cousins, Alex and James Fitzgerald. If you've got a burning question or something we absolutely need to talk about on the pod, please write to us. Both of our emails are in the show notes. For little real estate tidbits and a little bit of banter, okay, a lot of banter, you can follow us on the gram. Our handle is thedoubleshot.podcast. That, my friends, is thedoubleshot.podcast. Until next time, think of us when you sit back and sip your next double shot.